Hi everyone, Kurt here. You might have seen the news recently. The Los Angeles Lakers were just valued at about $10 billion USD in a majority sale to Mark Walter, the co-founder of Guggenheim Partners. That's now the highest valuation ever for a US sports franchise. What makes the number so fascinating is the mix of scarcity, brand, and media rights growth that's baked into the valuation. I thought it'd be fun to take a look at that context and ask, what if the NBA expanded to Vancouver? The NBA has expressed interest in expansion in the future. The estimated expansion fee is about $5 billion. I thought it'd be a fun example to walk through financial model structure and how you would go about the exercise of thinking about that valuation and say, if you're an ownership group looking to invest in the NBA and believe that there might be an opportunity in Vancouver, this kind of model will help you better understand the economics, how the business needs to run, and what is sort of the fair value for paying that expansion fee, where you're still able to really justify the investment. More importantly, I'm going to use this as a way to show you the structure of my template. So this isn't about predicting Vancouver's precise value. It's more of a scaffolding. And, of course, if you were dealing with a transaction of this size, you would have a team of functional area experts that you'd likely be working with to really refine and run to ground all of the different assumptions that you're putting in the model. But this provides the sort of structure that you would need to go through that exercise. We're going to walk through together some of the model structure choices, the critical assumptions that have gone into this model, and what a model like this tells us. So before we get to Vancouver, let's anchor ourselves in what makes the Lakers' $10 billion valuation unique. The first thing is scarcity and legacy. So only 30 NBA teams exist, and the Lakers are one of the most iconic global brands in sports. Second is media rights. So the NBA just signed a new 11-year, $77 billion national media rights deal. That's recurring revenue growth locked in for every franchise. And third, multiples. Buyers aren't just paying for today's cash flow. You'll see in a minute that for NBA franchises, typical DCF valuations don't always work well for a valuation like this because of how much the valuation depends on the multiples on exit. It's not really a strong cash flowing business relative to the purchase price and the sale price that you're going to get for it in the future. They're paying for growth in the business, the global reach of the brand, merchandising, and of course, the main piece, that eventual resale. The $10 billion number implies a very healthy multiple on revenues, which is uncommon in most industries. Fourth is risk. Operating costs are massive, player salaries, staff, facilities. If assumptions don't play out, or if media revenue underdelivers or costs inflate, the margins on this business can compress very fast. So now let's flip the lens, and what if we modeled a brand new Vancouver expansion franchise team? Obviously, the assumptions are very different. Smaller markets, it's a less global brand. You're attaching yourself to the NBA brand, but a Vancouver brand doesn't really exist currently. And then there are higher startup costs. So the structure of the model is similar. There's a distinction between purchasing a franchise from another party and paying an expansion fee, which to my knowledge would impact taxes and how you would treat the tax treatment on those two cash outlays. But the structure of the model itself is quite similar. And that's the point. No matter how speculative the exercise, the template forces clarity around assumptions, sensitivities and risks, and what really drives value. So let's get into it. We have our revenue assumptions here. So the revenue is going to be based on ticket pricing, broadcast revenue growth, media sponsorships, merchandise, etc. And then costs are going to be based around player salaries, staff salaries. If you're leasing the arena, then you would have the lease cost and some O&M likely, and then also costs like travel and marketing. There are likely going to be capital expenditures each year to maintain the facilities, and then you might have an initial capital expenditure in a expansion fee scenario where you're, say, making improvements to the facilities, building locker rooms for the players and training facilities for the players, or building in medical facilities, that sort of thing. There's probably going to be high initial capital outlays at the onset. Importantly, so we're going through this inputs tab here. There is a sources tab as well, because a lot of it is quite public. I've actually just mostly done some desktop research to try to understand what are reasonable assumptions for these different inputs. And then, of course, for something like player salaries, there's a salary cap. So it makes it a bit easier to project. And then, of course, things like ticket pricing and national TV revenue are public information, which makes this a fun exercise because although our assumptions might not be perfect, we do have a lot to work with. This tab right here is the fulcrum of the whole model. You really want to, for strong integrity in the model, have all your inputs either in a static sheet like this, or maybe you have a second one with your series inputs. So inputs that go across the timeline. You might want to do something like, if you believe ticket prices are going to fluctuate each year or steadily increase at differing percentages each year, so it might be 3%, 4%, 5%, back to 3%. You might have a series inputs tab for that. But for this, to keep things simple, I've just done static inputs. So what that means practically is, we have a average ticket price here, and then we have at the bottom just static escalation curves. This isn't very realistic always, but we're basically just assuming the same static amount of growth each year. So we're able to use just this static inputs tab. The layout of the inputs tab here, I learned a lot from the full stack modeling program, which I would highly recommend. And I really like a couple of things here. So the first being, if we change the scenarios here, you can format your top row so that it's got this little arrow moving across, which is nice. It makes it really clear what scenario you're running. So we're going to toggle back to 1. The other thing you might have seen is if we change the scenario, you can actually format to see the different input differences. So this is saying your comparison scenario is your base case, and then your active scenario is 3, right? We see the little arrow, and then it'll start to show, okay, so average attendance. This is our upside case. We're saying 19,000 fans per year. Base case is 18,000, so it's flagging that there's a difference, and you can go and kind of check on all your differences there. And then I'll just switch this back to 1. One other thing I'd like to mention, because I've had this challenge with building my models, and I think that this is a great workaround, but often if you're working with a client who maybe doesn't have as much experience with models, the least overwhelming way to present the information may be a dashboard like this. And so you kind of have your key assumptions here, a lot of what we just saw in the last tab, and OPEX, so investment assumptions, revenue, OPEX, and then your escalators, your static escalators. We've got the inputs that are telling a lot of the story, and then right below we have some outputs. We've got our unlevered IRR here, which is about 7.5%. And this is what I've been referring to with where you're really generating value on the purchase and sale of an NBA franchise. We've got this unlevered equity return tab here, which is showing the cash flow in the business. And you can see here, 5 billion US purchase, and then we're assuming a 16x revenue multiple in 20 years. And these are the annual cash flows here. So you can see quite a bit smaller. This is a top line revenue number here. So these are all net numbers. This is your net cash flow at the bottom. And then here is a 16x revenue multiple. So you can see that you're essentially getting the return on this investment all at once on sale. Although just for the health of the business and liquidity purposes, you'd want to make sure that you're still generating positive cash flow. It appears that a lot of these NBA franchises, where you're getting a return on your investment is on the exit. What's interesting about how this is set up, though, is we have this activate dashboard scenario macro, and then there's a reset to base case macro right beside it. So if you click this activate dashboard scenario, what will happen is that this active scenario is going to flip to 8, and then 8 is actually linked back to this dashboard tab. So we have don't edit here, and I actually haven't gone through with the process of linking it yet, but this dashboard scenario tab, you would, let's say for average ticket price. So you would go average ticket price equals, and then you would go to your dashboard, and where's our average ticket price? You would equal there, right? And then we'll change this to currency. And then you would do that for all of these different dashboard inputs and make a little note not to edit this dashboard scenario. And then you can cleanly keep the integrity of your inputs tab and make sure that everything is flowing from here. You also get the added benefit of having this option to kind of take a sky high view of the model. So this is something I really like to do. I don't think it's very common in the financial services industry, but it's a really great way, I think, to have a dashboard. And you can see the dashboard scenario is not active right now. It's a really great way to have a dashboard, but still have strong integrity through your inputs tab. Okay, so moving on from there, you want to have your inputs tab with all the assumptions in one place, telling the story. And then you want to have logical calculations / working tabs. So we can start with, I'll just scroll through these a little bit because they're all flowing from the inputs tab. But I think really important for strong modeling is you want to have a fairly robust time tab in a lot of cases, strong flags and strong timelines like this. So you see transaction flags. And then I think below, yeah, we've got some escalation factors here showing annual growth on things like ticket prices. For the flags here, what this really helps with, this isn't necessarily very common from what I've seen in industry, but why you want to have the flags like this is because it helps keep your formulas in your working tabs more easy to understand, because you're not constantly repeating these formulas that you see up at the top here every time you're doing stuff like ticket sales. You don't want to be making these formulas too complicated. So we do these timing formulas here. We have time rulers, and then we were able to sort of simplify our calculations throughout the workbook. So let's look here at regular season ticket revenue. We've got our escalator being applied every year. Very clear, right? Escalator every year. So by June 2029, our ticket prices have gone from $100 to $108 with that 2% escalation every year. Here's where the flag comes in from our time tab. So we don't obviously want to count revenue before the franchise is in operation and in our control. So we reference this flag here, franchise operation flag, and then we're doing the $100 per ticket, 18,000 seats per game, 41 home games, and we're getting our annual ticket revenue here. The reason that I've got that units in 1,000 number is because for the ticket price, I've shown it in real dollars, but to make the model more digestible, we're showing things in thousands of dollars. So this is just to take that back. But these calculation tabs here are much easier to understand than if you had taken this franchise operations calculation and embedded it into this formula. So that's the purpose of that. Also, it makes it really easy to trace back to your inputs tab, all of these inputs are traceable back to inputs. So you're able to understand all of your assumptions very quickly at a high level. And you'll see this structure is consistent throughout the operations tab. We're looking at different types of revenue, and we total them all up at the bottom here. The structure is essentially the same. You've got your inputs and then your escalator and your flag for each calculation, and then you're essentially just multiplying them by each other. So this is a great way to lay out your operational calculations. And then we can go into OPEX here, but again, it's the same structure. Lastly, I've thrown capital expenditures and the terminal value into here so we can see this would be tracing up to our total revenue, 074. And then if you go to the end, I'll zoom in a bit more, we get the flag that the franchise is being sold, franchise disposition flag, and we're going to go ahead and multiply the exit multiple by our 2046 revenue here. That's how we get our 16 times disposition exit value flag, terminal value there. So we've got our depreciation and amortization. Again, similar structure for the top calcs here, but we do a corkscrew calculation because each year we're amortizing out this franchise expansion fee. This is where it being an expansion franchise is important, because if you were purchasing a franchise from someone else, then you would not amortize the value in this way. And what is beneficial about this is it's being netted out from your taxes. This is an advantage of an expansion franchise fee, is that you're able to amortize it out like this. Then we have our depreciation of capital expenditures, our initial capital expenditure outlay on financial close, and every year we've got our capital improvements going through. And again, we just keep this as a corkscrew so we know our balance. Lastly, we've got some financing assumptions here. I looked up the liquidity. There are sort of strict liquidity requirements in the NBA, and you're not allowed to leverage the franchises very highly, which is something unique about owning an NBA franchise. So we've got fairly small loan here for the acquisition that we're paying back by 2033. You can see it's quite a high DSCR because it's really low leverage for the size of the business, but this is something unique to the NBA. For this exercise, I just kept everything unlevered because that shows you sort of the core value. There are such strict liquidity requirements in the NBA. We could go through and do this financing exercise to see what the levered IRR is, but it likely won't move the needle much because it's a low amount of debt in the business. Lastly, we look at our taxable income, any tax losses that occur, and then we figure out our cash taxes payable. Because of this amortization and depreciation schedule, we are not paying taxes until a bit later into the term, and then it starts to ramp up quickly each year. And then lastly, we get to our cash flow tab. The cash flow here is really just a summary. It's what you might end up putting in a slide deck to the investment committee. We work down to this 7.5% unlevered IRR, which is not a healthy return necessarily, but something else important I forgot to mention is that owning an NBA franchise for a billionaire can be a bit of an emotional purchase. And to me, it's not out of the question that, a investor, even if in good faith they thought it was going to be a 7.5% post-tax unlevered return, that they might just want to be the owner of the Vancouver expansion team or the LA Lakers, and they would just go with that. So the unlevered return we're getting based on all of our assumptions is about 7.5%. And then quickly here, we do have outputs. I'm going to be using this model moving forward as a template. So I think I'll walk through things like outputs at a later date, but typically here you would have anything that's going into investor reports or If you wanted to do more charts, if you were doing debt service coverage ratio calculations, any sort of internal metrics that you use, you might throw that into an outputs tab. You would want to see how sensitive your model is to different inputs and assumptions. So seeing what if revenue, instead of 2%, it was growing at 3% every year? How would that change your unlevered IRR and your cash flow? Another example, what if player salaries increase quicker than you thought they might? How is that going to impact the cash flow in the business, the valuation, the unlevered IRR, that sort of thing? So just understanding which inputs you need to view with more of a critical eye and which ones you might want to invest more in really understanding, bring in an external consultant maybe, that sort of thing. Lastly, you just want to have checks in your model to ensure that there's no obvious errors in your calculations. So things like if you're doing a three-statement model, you might want to make sure every period that assets are equaling liabilities in shareholders' equity. That would be a very common one. Another is maybe you want to check that you're meeting your DSCR requirements every year. You would throw these all in sort of a checks tab that I like linking. Right now it's not linked, but I like linking to error checks of each tab so that it's kind of a bright red blinking light and you see, okay, if there's something wrong with the model, one of the scenarios I'm running, calculations broken or that sort of thing. And then you would click through on this, it would take you to your checks tab and it would tell you what's going on. Okay. Lastly, I just wanted to speak to why we're so focused here on operating cash flow plus your capital expenditures and the terminal value. It is not a three-statement model built up with balance sheet projections. Why is this? It's because in valuing an NBA expansion franchise, what really matters is the cash generated from operations, the media rights, ticketing, sponsorship, merchandise, and then you want to subtract out obviously your operating costs and capital costs. Balance sheet detail can matter in some contexts, especially if debt is a big factor or if working capital is volatile. But here, as mentioned, debt financing is quite secondary and working capital swings aren't what drive the story. This mirrors how sports franchise valuations are discussed in practice, typically revenue multiples or multiples of operating cash flow, not book value on a balance sheet. So by focusing here, the model highlights what investors and buyers are actually looking at, scalability of revenue, and then the leverage of fixed costs. We've got Vancouver here at 7.5%, and we just want to kind of understand what is this model telling us. So for Vancouver, essentially the biggest lever here is going to be again, you can see here we've got our revenue and operating cash flow. So you can see that there's fairly healthy margins each year in our assumptions. But again, what it all comes down to is really this unlevered equity return tab here, which is showing you very visually where the value is coming from. This is the cash flow that we're discounting back to today. And so you can really see you're not getting a lot of value until your exit here, which again is standard for an NBA franchise like this because they're valuing on such healthy revenue multiples. A clean model like this forces you to state your assumptions, run scenarios, and see sensitivities so that you can understand how charts like this will change, how this final number will change, this final investment return. You can outline a range of what you're expecting in this investment. But yeah, this sort of 2027 to 2045 period, the more important consideration is, do you have enough cash to continue operating the business? You're not as concerned with the actual return on investment during this period. You want to make sure that when you're at a steady state, when you're going to sail in 2045, 2046, that you have a really strong top line number plus a healthy operating margin so that you get a strong revenue multiple, and you get your return all at once here. We're projecting that the Vancouver franchise would be worth about 13.1 billion by 2046, which would potentially break another record. This seems pretty reasonable. If it's valued at 5 billion today, you improve the business for 20 years, 13.1 billion. If the NBA is still performing strongly as a league, it's a very plausible exit multiple, and that's where you would be getting your return. So that's the walkthrough. The Lakers valued at 10 billion a few months ago, the Vancouver expansion as a case study, and a look at how structured template exposes inputs, assumptions, and valuation levers. This wasn't about predicting Vancouver's exact value, but to show how financial modeling works in practice and how you start to build that structure and think through opportunities. I'm going to be using this template in the future for a few exciting projects that I'll share through a video format like this. Very excited to continue with the dialogue. And I know that there's a very experienced group of finance and consulting professionals are following Novus's progress. Please, if you have any questions or feedback, I'd love to hear. This is a journey that Novus is going on, and I'm really hoping that it's going to feel collaborative and that we're going to be able to explore these topics and learn together over time. So please, if there's any comments, feel free to share. And if you like the video, just give me a like at the bottom there. Thanks, everyone. I'll see you soon.